Hi, everybody. Welcome to our live stream. I'm Tom Proshill, and today we're going to be discussing what's happening with banks in the US and around the world. So, welcome, everybody. As we go through the live stream, feel free to use the chat. You can say hello in the chat. You can ask any questions that you have, and I'll try to get to them. Either at the end or during the presentation, however it works. I have some material that I have prepared that I'm going to present, and then at the end we definitely have some time for a discussion. Because I've been getting hi Jan in the chat. Jan said hello, Tom. Hi Jan. I've been getting a lot of questions from people like why are banks collapsing? Where are all these problems coming from? Is my bank safe? What can I do to protect my money? What does this mean for investors if you want to invest? These are the topics that we'll be covering today. We'll also talk about why, in an interesting way, crypto actually bears a bit of the responsibility for the current problems. And it's also interesting that a lot of people are saying that crypto is the solution to the current problems. So that's interesting. We'll discuss that. We'll talk about what's happening with Credit Suisse, the enormous Swiss investment bank, which plays a very important role in the global financial markets, and whose stock price basically has been looking like this yo-yo these past few days. There was a big drop and then a huge bounce again. Okay, so these are all the topics that we're going to be discussing. And as you're watching this, I encourage you to hit like on this video, just so more people find this stream. That's the way the YouTube algorithm works. Okay, if you hit like, then more people find it. Of course, if you're not following my channel, do it. I focus on helping European investors, and we post a lot of good content. Okay, but let's start. So let's start with what is an inconvenient truth. Okay, the inconvenient truth is this: no bank in the world is completely safe. All right. It's not because bankers are incompetent or because they're greedy or because they take too much risk. Although sometimes that can happen, it's just kind of built into the system. Okay. So when you think about it, there are two ways a bank can get into trouble. Okay, one, it makes some kind of dumb investments or it takes dangerous risks and then it loses a lot of money. So if you remember the big financial crisis 15 years ago, I mean, I remember it very clearly because I started my career back then on Wall Street. What happened back then was that a lot of banks made some really dumb loans, bad loans to low quality borrowers. They invested in toxic assets like mortgage-backed securities and CDOs, right? And then hundreds of banks failed globally, including the giant American bank, Washington Mutual, the investment banks, Lehman Brothers and Bear Stearns. They mostly failed because they made really bad decisions, bad investments, okay? And that's the first way a bank can fail. And of course, if that happens, that is the fault of the bank, of the management, and maybe also of the regulator, okay? Because the regulator should have been watching more closely. And there has been a little bit of that happening, okay, with Silicon Valley Bank and Silvergate, these American banks that have failed. We will talk about that. But this time is a bit different than back 15 years ago, okay? Because there's also a second way for banks to fail. And yeah, hi, Memento Mori, Manos, I see that you have questions in the chat, so I will get to them in a second. So there's a second way for a bank to fail, which is a bank run. Okay, so the basic idea with a bank is that it takes deposits from you, and then it kind of promises you can get this money back whenever you want. Okay, you log into your internet bank, whatever portal, and you can make a transfer out at any time that you want. But then the bank turns around and it lends these deposits to other people or businesses, or the bank makes other long-term investments. Okay. So there's actually nothing wrong with it. It's exactly what you want a bank to do, right? One of the functions of a bank in our society, in our economy, is to finance mortgages so we can buy houses or apartments, to finance businesses, okay, so that our economy can grow. But there is a problem because all these depositors can ask for their money back at any moment. And if that happens, no bank has enough cash on hand to cover all deposits, okay? The bank can be like really competent. All the loans and investments can be really high quality and reliable. But let's say, for example, if you're a bank and you have 20 billion euros of cash on hand, but suddenly you had to pay out 100 billion in deposits. I mean, there's no way you can sell 80 billion euros worth of loans and investments fast enough and at a good price to give everybody their money, right? So if a lot of clients run for the door at the same time, the system breaks, the bank fails. And this can happen to any bank, to any bank. It can happen to my bank, to your bank, to any other bank in the world. Okay, it's inherent in the way banks work. Yeah, they make you these short-term promises that you can get your deposits back at any time, and then they go ahead and invest in longer-term investments. Okay. And now, of course, I mean, banks have a responsibility to make sure they have plenty of reserves and they have short-term investments and cash and everything else so that they can pay out money when people want it. But if too many people run for the door, I mean, any bank can get destroyed that way, okay? It doesn't mean, by the way, it doesn't mean that the clients actually lost their deposits. If the bank has made smart investments and smart loans, eventually the bank will get the money back, yeah, from the borrowers and everybody else, and they can pay back the deposits, but it can't do it immediately. Yeah, and that's why a bank run can cause a bank to fail, even though there's plenty of assets. The bank owns plenty of assets to cover all deposits, but they just can't come up with cash quickly enough to pay everybody back, okay? Now, in a second, we'll discuss why this kind of risk is higher today in 2023 than it was maybe a few years ago. Okay, and we're also going to talk about the defenses that are kind of built into the financial system that generally keep our money pretty safe. And we'll talk about some things that you can do to stay extra safe, okay, as somebody with money in the bank or as an investor. All right, so we'll discuss that. But right now, let me encourage, say hi to everybody who just joined us, and encourage you to hit like so more people discover this. Okay, subscribe so you get our cool videos. All right, so we discussed that there are two ways for banks to fail: losing money and then a bank run. Okay, and then of course the worst cases are when these two problems, they kind of combine and feed on each other. So that happened a lot these past couple of weeks. So first of all, if we look back at March 8th, there was a crypto-focused bank in America called Silvergate, which announced that it was closing down. And this was actually kind of pretty much a direct result of all the crypto scams and blowups that we saw in 2022. So this is how, in a sense, a little bit crypto is responsible for what's happening right now, because it kind of started this domino effect. So Silvergate's whole business was focused on serving the crypto industry. And after the crypto exchange FTX collapsed last year, Silvergate's depositors ran for the door. It was basically, it kind of started as a run on the crypto industry and crypto marketplaces, but by extension, it became a run on Silvergate because Silvergate was serving this market, okay? So the bank's deposits from crypto-related customers fell from around $12 billion at the end of September 22 to $3.8 billion at the end of December, which is just a massive, I mean, that's like an $8 billion decrease. Most of their deposits left in a quick time. And the amazing thing is, I mean, Silvergate, it looks like they were actually highly competent in how they managed risk, because they kept paying out and paying out and paying out all these deposits for a long time. They could stomach all these withdrawals quickly and keep going. But there is a limit to everything, okay? So they had to borrow $4 billion from this quasi-government agency. They had to sell a lot of their long-term investments, and they lost $700 million doing that. There were other problems at the bank. It was just too much. And on March 8th, the bank announced, okay, we're closing down. We can't really keep going. They said they're going to return all deposits in time. We'll see whether that's true or not over time, whether there was enough assets there to do that. But, you know, the bank failed. It wasn't able to keep going. And so if we look at this one example, we see that Silvergate, their mistake was, you could say it was putting all eggs in one basket. Yeah, putting all eggs in the crypto industry. And when that basket fell, all the eggs got smashed. Yeah, they couldn't keep going. Now, normally, if you see something like Silvergate collapsing, it wouldn't have been a big problem for the global financial system because it's really quite a small bank. But as it happens, on the same day, March 8th, a much bigger institution, which is called Silicon Valley Bank, announced that it had to raise around $2 billion in capital from the market. They had to attract new capital. Because it turned out that the bank had also been losing deposits fast, although for different reasons. It had also had to sell some long-term investments. It had lost some money on that, and it needed to kind of shore up its capital position. So, like, as the name suggests, Silicon Valley Bank, it provided banking services for a lot of startups and tech companies. And because the past few years have been kind of a difficult environment for startup investments, a lot of these companies had simply been, spending their cash and taking out their deposits. Okay, so as deposits fell, Silicon Valley Bank had to sell long-term investments to come up with money. Okay, and so this is how they lost a bunch of money. Now, if you look at the big picture, $2 billion is actually not a lot for a big bank like Silicon Valley. Yeah, they had $170 billion in deposits. They had a market capitalization of $16 billion at the time. But the bad thing was that, like, this news came out at the same time as Silvergate failing. And the market looked at it and they were like, okay, here's one bank which saw falling deposits. They had to sell long-term investments. They were losing money, and then they had to shut down. And now there's a second bank which is saying, well, deposits are falling. We had to sell long-term investments. We're losing money. And, the similarities were just too much, like to have this happen on the same day, and the markets got spooked. And then, when the markets get spooked about a bank, it can quickly become a self-fulfilling prophecy. Because once you start asking questions about whether a bank is stable, it's really hard for a bank to stay stable. The customers of Silicon Valley Bank started talking among each other, getting really worried and pulling out money. And here's the thing, like, when you have a bank that is focused on serving companies, not individual clients, and a lot of these companies have a lot of money at the bank. So in the US, you can have up to $250,000 in a bank that is kind of guaranteed by their local, the American, the SVB deposit insurance. But most of these companies had way more at the bank, so this money was not protected. So they kind of freaked out and started pulling out a lot of money, like tens of billions of dollars worth of deposits within hours. Okay. So it was just too much. It was too much for the bank to handle, and the US government stepped in and closed down Silicon Valley Bank. And at that moment, it was the second biggest US bank failure, American bank failure in history. And then literally within days, there was the third biggest US bank failure in history when Signature Bank collapsed. Okay, this was another bank with a strong involvement in the crypto market. And it suffered a bank run because customers saw what had happened to Silvergate and Silicon Valley, and they started pulling out money from Signature. And then, of course, the stocks of other banks fell a lot, both in America and around the world. People had been worried about a bank called First Republic in the US, which, by the way, just received a lot of aid from other big American banks to stabilize it. Globally, maybe the biggest focus in recent days was on the giant Swiss bank Credit Suisse. So where the day before yesterday, the stock price of the bank fell dramatically. Then yesterday it came back up when the Swiss National Bank said it would support the bank with a lot of money. Okay. And now the markets are kind of watching to see what will happen next. Everybody's watching to see what will happen next. Because on the one hand, we can argue, and I'll show you how, that these were kind of, in a sense, idiosyncratic events, meaning that there were some specific circumstances, specific reasons why these banks ran into trouble. But on the other hand, there is some background. There are some things happening in the global economy and in the global markets, which potentially could make things risky for other banks too. Okay, so that's why the markets are on edge, and of course, regulators and governments are also kind of paying a lot of attention. Okay, all right, so why did these three big banks fail, one right after the other? Okay, why does it look like March 2023 is a really dangerous time to be a bank? Well, part of the story is explained just by crowd psychology and what's called contagion. Okay, so if Silvergate hadn't failed, if there hadn't been all these crypto issues, if Silvergate hadn't failed, then maybe Silicon Valley Bank would have just raised a couple of billion dollars in the market without any trouble. If Silicon Valley Bank hadn't failed, okay, then Signature Bank would still be with us, and so forth. Yeah. So part of it is just crowd psychology. Another part of the story is these banks' business strategy. Okay, so the funding sources of these banks were really not quite diversified enough. Okay, so Silvergate took most of its deposits from the crypto industry. So when this one industry took a big hit, that was a big problem for the bank. Okay, so that's a real business risk that they should have kind of anticipated. Silicon Valley Bank took most of its deposits from businesses such as tech startups and venture capital firms. Okay, and these companies were really quick to pull out money because most of them had more than the insured amount at the bank. Okay, I mean, if people like you or I, if we have 20,000 euros at a bank in Europe or 50,000 euros, for example, in Europe, the first 100,000 euros at a bank are guaranteed. They're protected by these local and national deposit protection schemes, okay? So we don't really get that worried. But if you have 500,000 or 1 million at the bank and you know most of that money is not protected, then as soon as you see any trouble, you're going to be pulling it out, right? So Silicon Valley Bank had a big exposure to this kind of risk because its clients were, really dominated by these companies with big deposits that were very sensitive to these issues, okay? And then Signature Bank, it kind of had a combination of these problems. It also had a big crypto exposure, and it also served mostly businesses, okay? So you can say, look at these cases, and you can say, okay, well, these particular banks had some very specific problems. But there is also, on the flip side, there's a big structural reason, okay, which really does make kind of the present moment in time particularly dangerous for banks. And this structural reason is, well, a couple things. Part of it is, of course, the kind of uncertain and economic environment, which is hurting some areas of the economy, such as certainly startups. But the biggest structural reason is high interest rates. Okay, so for many years, we have lived in a very low interest rate environment. Yeah, so businesses could borrow at very low rates, banks could borrow at very low rates to keep the economy going. Central banks kept interest rates very low. So what does that mean for banks? Like on the one hand, that meant that banks, they had very cheap funding. Yeah, they took deposits from you and paid you next to nothing for these deposits. But on the other hand, it meant that when the bank got your deposit, it didn't have a lot of attractive ways to invest this money. Okay, if it handed out loans, it was at pretty low interest rates. And if it bought safe investments, like, for example, European or US government bonds, the yield on these bonds was also very low. I mean, in some cases, negative here in Europe, or maybe 0.6% or 1% per year in the US or something like that, okay? And so to get a better return, to make more money, banks were, of course, tempted to buy longer-term bonds because the yield on these bonds is comparatively higher, okay? So banks were taking in a lot of deposits, which they had to be able to return at a moment's notice. But then they were turning around and making long-term loans and buying these long-term bonds to make some profit on these deposits. And now, as long as rates stayed low, that was a sustainable approach. You could keep going, right? Because if a lot of clients, for example, decided to take out their money at once, I mean, the bank could just go in the market and sell its bonds, even sell the loan portfolio to some other bank and use this money to pay the depositors, okay? So no real problem. Okay, but if you've been following the markets, you know that over the past year, because of high inflation, central banks around the world have been pushing interest rates up. Yeah? Since early 2022, the so-called Fed funds rate has gone up by over 4%. So that's a lot. Okay. So over the long term, it's actually good to have high interest rates if you're a bank, because you can lend at higher interest rates and make more money. But over the short term, it has become a significant problem. So, for example, when Silicon Valley Bank depositors decided to pull out their money at once, like here's what happened. And normally, like if rates were low, the bank could have just sold its safe government bonds to get the money and pay depositors. But the problem is that the bonds that the bank held are the old bonds, which were issued when interest rates were really low. So maybe these bonds, for example, let's say these bonds paid 1% per year, but today the market expects similar bonds to pay 3 or 4% per year, yeah, because rates have gone up. So because these old bonds pay a lower interest rate, their price is much lower. Yeah? And the same goes for loans, by the way. People don't appreciate it, but if a bank has made a lot of loans at a fixed rate, at a low fixed rate, then these loans are going to be a lot less valuable when interest rates go up, okay? So it's difficult to sell them quickly at a good price. So as long as everything is normal, banks use this kind of accounting trick, which is not really a trick, it's perfectly legal, which is where banks say, well, we are not holding these loans or these bonds to sell them. We're holding them for the long term. So we don't really care if the current market price drops because we're just going to hold them to term. Then we'll take the money and pay everybody that we need to pay, okay? And that works fine. But when all the depositors come and say, we want money now, well, this stops working. You can't pretend you're going to hold these assets forever when you have to sell them, and you have to sell them at a loss. And that's exactly what happened to both Silvergate and Silicon Valley Bank. They had these bonds, which they were pretending were, they're fine. Nothing is wrong. Everything is fine. We're just going to hold them to term. But in fact, the value of these investments had fallen a lot because of rising interest rates. And suddenly they were forced to sell these instruments and realize the loss. And that's how for example, Silicon Valley Bank lost like $1.8 billion selling these bonds, okay? And this is an issue that is not limited to just Silvergate or Silicon Valley Bank. Yeah, because the big question the market is asking right now is, okay, what about all the other banks? What do they really have on their balance sheets? Like, how much risk do they have sitting on their balance sheets that people are not aware of? Yeah, if they have to come up with money quickly and sell their loan portfolios or bonds or whatever, at what price can they sell? And what's going to start happening to the stability of these banks, okay? So that is what has people on edge, and kind of really, as soon as you see that something might be a little sketchy somewhere, the market becomes very sensitive to it. Because, I mean, as long as business keeps going as normal, there could be a lot of banks out there which have these long-term bonds at low rates, and that's fine. You can just wait and wait and wait, and eventually the problem will just go away because the loans and the bonds will mature, they will get back the money, and they can invest at higher rates. But if the psychology of fear spreads through the market and more bank runs happen and more banks have to come up with money quickly, then potentially more banks could be at risk, okay? So that's kind of the bad news. And that's why I said in the beginning that no bank is completely safe. And I'm going to move on to the good news. But first, let me say hi to everybody who joined us and encourage you to hit like so even more people discover this live stream. It really helps on YouTube. And also hit subscribe because we do post a lot of good content on this channel. So I don't want you to miss it. Okay. All right. So, but here's the good news. There are defense mechanisms in the financial system to guard against bank runs. And there are also things that we can do, okay? There are also things that we can do as individuals to stay safer, all right? So first of all, both in Europe and in the US, there are these basically deposit protection or deposit insurance programs. So in Europe, if you have up to 100,000 euros in a bank, that's protected in a single bank, okay? So this, when you're a smaller depositor and you're not maybe that wealthy or don't have that much exposure to a single bank, that means that if you see some slight reputational issues or something, maybe you're not as sensitive, okay, because you are protected by this program. So this kind of serves as a way to dampen the system, to reduce the risks across the whole system. So one way we can protect ourselves, by the way, if you are wealthier and if you have a larger amount of money, well, why not spread it out a little bit, okay? Why not have, if I have 150 sitting at one bank, why don't I split it and have 75 sitting at one and 75 sitting at another bank, okay? So that I've split the risk, and at both banks, I'm under the limit, okay? So that's one thing you can do. Another thing that you should be aware of, that these limits, the 100,000 euro limit, that applies to all kinds of bank deposits. But another way to protect your money is actually to invest it. So for example, if you own some quality bonds or if you own stocks, even if the brokerage or even if the bank goes under, that is held separately and you still own those instruments. You haven't lost them. Yeah? So these are things we can do to protect ourselves. And then at a system-wide level, okay, so regulators and governments use these insurance mechanisms to kind of make sure that people don't run for the door really quickly because they have this assurance that the money up to this amount is protected. And then actually with these past few collapses in the US government has been even more proactive, and they've come in and said, well, listen, actually all deposits at these banks are protected. They're going to be available, and there's not going to be any problem. And of course, it's created some political issues where people are saying, well, the big fat banks are getting bailed out again. From what I can tell, that's not really what's happening. So I doubt the shareholders or the owners of the bank will stay in very good shape or will benefit much from this. Actually, I actually think personally that it's quite justified what's happening, because as I said in the beginning, any bank can collapse because of a bank run. So if this crowd psychology effect starts happening, but as long as there's enough good assets at the bank to eventually pay depositors back, well, then in my opinion, it makes sense for the government to step in and say, okay, well, we're going to, like, in the meantime, we're going to keep everybody good. You know, we're going to help people keep doing business and not freaking out. And we're going to prevent this fear from spreading through the whole system. Because at the end of the day, hopefully, the government doesn't actually have to lose money on this. Taxpayers don't have to lose money on this. They just have to help out while, you know, during the process of converting these long-term assets that the banks have to short-term cash, which can be used, you know, to give depositors their money. Okay. So that's the good news. We have some individual mechanisms we can do. We can split our assets between a few different banks. We can invest because our investments are protected if something happens to the bank. But then big picture wise, seeing how proactive regulators and governments have been, I mean, I don't have a crystal ball. I can't predict anything with 100% certainty, but I'm not too concerned about the system as a whole. I'm not too concerned at this point because it was a different problem 15 years ago when a lot of these banks really held crappy assets which were worth nothing. Now we're talking about banks which hold good assets a lot of the time. It's just their long-term assets where the current price has gone down, but over time the value is there, right? So it's a different kind of picture. And as long as we prevent these bank runs from happening, the system should be able to work through this and keep going okay. So if the government is active enough in supporting banks and calming fears, I think it should be quite all right. Okay, so that's my kind of big picture look at the situation. There's a couple just two more things that I'm going to address, and then I'll get to the questions. So if you have any more questions, you can put them in the comments section. So I also wanted to touch briefly on the Credit Suisse situation. So for those of you who don't know the bank, it's really a major player in the global financial system. It's one of the two big Swiss investment banks. The other one is UBS, where I used to work. And Credit Suisse, the past few years, it's been in the news with all kinds of various management and other problems. And then recently there were some news that came out that the market really didn't like, which is that apparently there were some unspecified issues or problems with financial reports and risk reporting in the past few years at the bank. And as a result, I mean, the bank has really been hit. The reputation has been hit. The trust in the bank has been hit. Stock price really collapsed a couple of days ago. Then the Swiss National Bank came in with many tens of billions of euros and said, we're gonna support the bank, and the stock price came back up. And it can be surprising, like, how is it possible that such a big, important, powerful, profitable financial entity can suddenly seem so precarious? But the way I put it is like this. I even did a short like an Instagram reel on this, which is the way I put it is Credit Suisse And other big investment banks, they're basically like Hogwarts, the school for magic in Harry Potter. They look like a really solid institution from the outside, but there's financial wizardry, excuse me, happening on the inside. You've got your chambers of secrets and dangerous snakes and weird ghosts flying all over the place, and the regulators, or the Ministry of Magic, whatever, they don't always know what kind of risks are being taken. Even bank management or the teachers, they don't know what kind of risks are being taken and what kind of problems there can be. So when a bank like that announces that there have been some irregularities in reporting and whatever, it's almost worse than saying specifically that there was this big problem, because everybody starts asking, well, what was the irregularity? What was the problem? What's really happening? There's this feeling that nobody really knows all the risks with these big banks. I can tell you from having worked in investment banks, I mean, it's really not that difficult for some small group in the bank to enter in some huge deal, complex financial deal, which potentially can have risks that, can cause a lot of problems for the whole bank, right? So that's what people are concerned about. Now, I think with the Swiss National Bank coming in a big way, I mean, that does a lot to kind of calm the markets and help, and hopefully, we'll just the bank will be able to move through this situation, and it will all calm down. But I hope that this kind of helps understand the concern. It's not that we know specifically that there are some huge problems. It's even the hint of potentially, yes, there could be some problems, really freaks people out, because everybody remembers the financial crisis and they start thinking, okay, well, what's going on? What's happening? Maybe there's something we don't know, right? So that's what happens. And so the last item I want to touch on related to this is this whole issue is from an investor's perspective. Okay, so mostly on this channel and in my training programs, I talk about investing for the long term. And there, our mantra is pick a good strategy and stick to it. And that is the more interesting or difficult a time is in the market, the more important that becomes. First of all, of course, you always want to make sure you have a safety cushion sitting in your bank or in cash or whatever. You have some uninvested money in case things get tough in the economy, so you have money to spend. That is important. But beyond that, okay, we set our long-term goals. We pick an approach, for example, to invest every month or every 3 months or whatever. And then we do it. We do it when the market goes up. We do it when the market goes down. We do it when there's fear in the market. We do it when everybody's happy. Because if you start trying to second guess yourself and figure out the best moment to buy or sell based on what's happening with banks or something else, history shows us you will almost certainly screw it up and make less money than if you simply stayed calm, didn't stress out, and just kept investing at a regular pace. Okay, so that is the general approach. Now, of course, you have to be aware of your personal situation. If your personal circumstances change, for example, I know that, for example, in my case, I know that I will need, because I have some family plans, I will need maybe 50,000 euros in 6 months. Then, okay, maybe I'll sell some stocks, put it aside, because I will need it in 6 months, because who knows what might happen with stocks in 6 months. That's short term. But for long-term investments, for your retirement or whatever, like if it's long-term investments, it's very important to kind of stick to your strategy and not overreact to things that might be happening in the market. Of course, everybody has to make their own decisions, but that's the general practice that works best most of the time. Okay, and with that, I'm going to turn to comments. So if you have more questions, put them in there, and let me see what we have. Okay, so Memento Mori was asking, what is the timing during a crisis to invest? I hope that that answers the question. Generally, it's best to just stick to your strategy and invest regularly. I will say there are some people who say, I'm just going to wait for the crisis. I'm going to wait for the big fall, and then I will invest. Generally, that doesn't work. If you really want to do that, it's really important ahead of time, figure out what is the level of the market at which I will buy, and then to be ready. You need to be trained. You need to have your account ready. You need to have your money ready so you can buy at that moment. Because a lot of people who say, oh, I'm going to wait for the big fall in the market to buy, then they miss the opportunity because they're not ready. The account is not ready. The money is not ready. Or when the market falls, they start thinking, well, what if it falls more? Maybe I should wait more. That is really difficult. It's like catching a falling knife, right? So if you want to try, well, good luck, but prepare ahead of time. But for most people, it doesn't make sense. So Memento Mori was asking, is it going to be worse in the US or in Europe? And is it better to have euros or dollars? That would be market predictions. And I can't predict what's going to happen in the market. A lot of people do it. If you want to look for predictions, you can find them all over the internet. But remember what Warren Buffett said. The only value of stock forecasters, or actually other market forecasters, is to make fortune tellers look good. Okay. So yes, Manos was asking, is it wise to buy ETFs now? I hope I also answered that. So the way I look at it is also, if I buy regularly, well, if the market goes down and I keep buying, that's going to be great because I buy ETFs at a lower price. If it goes up, also good because my existing investments are doing great. Okay, so psychologically, that's how you can kind of trick yourself. Yeah, so Jan was asking, what strategy would you apply now to invest, let's say, 50,000 euros, invest proportionally over the next few weeks? So again, the answer is the same as always, even though the market is a bit more frothy than usual. And the answer is that statistically, I can't give you a recommendation for you. I can just comment generally. Statistically, it is the smart choice is usually to invest all at once when you're investing some lump sum. Psychologically, a lot of people do prefer to kind of break it up over a few weeks or some period of time, just because psychologically it might be easier, because if the market goes down, then you feel like you're buying more at a better price. If it goes up, you feel like you're adding to a winning trade. But statistically, most of the time, it's smarter to invest all at once. It doesn't guarantee success. That's just statistics. Okay. All right. So Kier was asking, in times of crisis, should we temporarily abandon our buy and hold practice and sell ETFs to buy again once the prices are much lower? Again, can't tell you what to do individually. Yeah, I can only comment what the research says and what the math says. And the research and the math says it's like these are actually some of the specific moments which make buy and hold so powerful, because all the world is running around like chickens with their heads chopped off and freaking out and doing things which a lot of the time are mistakes. And statistically, most of the time, the buy and hold, the people who stay the course, do better. There's no guarantee that in any given situation, it's the right choice, right? It could happen that just this time it would have been better to sell and then buy. It could happen. But I don't think about it that way, because over time it's been proven that most of the time buy and hold is the better approach. And also it's just a lot less stressful. Okay. So it doesn't, it's just an easier way to live. All right. But again, your decision. And so then Libio was asking, should I pull money out of the bank and just keep some cash? Well, again, your decisions are yours. I personally am certainly not doing it. I am checking my accounts and making sure I'm diversified. So if I have more than 100,000 at some bank, to maybe split it among a few different banks, just in case, making sure I'm invested and don't have too much sitting at any one institution, just in case. It's always a good practice. But having a bunch of cash sitting around comes with its own very significant risks. Whatever, you can have a fire, it can get stolen. Again, there's stress, you have to take care of it. For me, it doesn't seem like the smart way to go, and probably most experts wouldn't call it the smart way to go. But again, of course, everybody makes their own decisions that way. Okay, well, any more questions? Pop them right in there. Otherwise, we're going to wrap this up. This is actually the first time I've ever done a YouTube live. It's been a fun experience having you here. If you enjoyed it, do hit the like. That's going to help other people discover the replay. And I appreciate you coming. Subscribe. We're going to perhaps do some more lives. And also, I have a really, really cool video about taxes for European investors that's going to come out in this account soon. So watch for that. And yeah, thank you everybody for taking the time on a Friday afternoon. Thanks, Jan. Thanks, Manos. Thanks, Kier. Great. All right. Mim says, do you still suggest ETFs instead of bonds? So great, we still have some questions, so we can keep going. I've never, I don't understand the word still, because I don't remember saying that you should buy ETFs instead of bonds. So you can use ETFs to invest in the stock market or in the bond market. And for example, in my training programs, I talk about how you can use both depending on how long a time you're investing. And what your what your risk tolerance is. Now, when it comes to investing in the bond market, for most regular investors, using a bond ETF versus regular just buying individual bonds is a lot easier and more manageable and more accessible, because buying individual bonds, unless you're quite wealthy and have access to advisors and brokerages and so forth, is usually not easy. It's hard to diversify. There's all kinds of problems. So if it's a question, should you just buy bonds directly or you buy bond funds? For a lot of people, bond funds are a lot more convenient and make a lot more sense. That said, in some cases, there can be possibilities to buy, for example, to buy your local government bonds if you trust them. There can be opportunities to buy some really trustworthy corporate bonds. And you can certainly look into it if you know what you're doing and if you know how to evaluate, like, is this bond price good or not? Because that's quite tricky. It's much harder than when buying stocks, for example. Francisco asks, how could past quantitative easing affect the current financial situation? Well, currently, I mean, certainly we are seeing, you could call it the hangover from the many years of quantitative easing and very low interest rates. Yeah. So the question is, how bad is the hangover going to be? And now that rates are going up very quickly. Okay. So it's a very interesting time. It is a very, very interesting time. And as long as you can keep this attitude that it's interesting and let's watch what happens, protect ourselves, have a good strategy, diversify among banks, among investments, and keep this attitude that's interesting, then it's fine. It's very important to stay calm, keep breathing, go for runs, go for walks, not read the news 24/7. That's not helpful, okay? It doesn't help anybody. Yep. All right, Tina asked, what is the investment? We talk about a lot of investments on this channel. Hit subscribe, you'll see more of our videos. Mostly we talk about long-term investing in stocks, bonds, investments like that through ETFs and index funds. Yes, so Tina elaborated, what is the best investment for beginners? Actually, I have a whole webinar on that that's coming up soon. You can go to go.indexmasterclass.com, sign up, and we discuss exactly this question. What is the best investment for beginners? Actually, let me put the link in the chat. We'll be doing that in a couple of weeks, and we have like an hour-long webinar where I cover what's the best investment for beginners, how do you start investing. At the end, of course, full disclosure, I also offer you to join my training programs, but in the beginning, we cover a lot of the big picture, and people usually find that helpful. Albertus was asking if it's better to invest as a private person or as a company from a tax point of view. That's very country specific. That's country specific and person specific. So we get into that in some of my training programs. There's no quick answer. You want to kind of calculate, okay, if you invest through your company, what is the tax situation? If you take out dividends and then invest, what's the tax situation? And then you have to think about like the risks of the company, because if you have your investments through your company and, for example, somebody sues your company or your company has some tax debts or something, it can affect your investments, right? So there's a lot of factors, but it really depends on the local tax laws. All right, well, thank you very much. Francisco says, thank you, I'm following your course. Great, glad to have you with us. Thank you, everybody, and have a nice weekend.